Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you're enjoying this show, do me one quick favor, leave us a rating and review. And if this is your first time listening, be sure to hit that subscribe button. Now, we got a great one today. We're going to be talking to Dr. Vanessa Peters. Dr. Vanessa Peters is the founder of VMD Investing and has been investing in real estate for 14 years, starting with single-family homes, but also in commercial real estate, commercial retail, apartment communities, short-term rentals, self-storage, land entitlements, and manufactured home parks. Now, she has invested in over 3,500 units across 40 properties and 6 funds. Let's welcome to the show, Dr. Vanessa Peters.
Thank you for having me. I'm so excited to be here.
Absolutely. Listen, I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, absolutely. So I'm originally from Canada and I'm a medical doctor, got all my training up in Canada, came down here after residency, family medicine, and was super excited to come to Southern California and get a job down here, mostly because of the weather. I mean, people ask me why, and that's, I got to be honest, that's it. And it's still a beautiful place to live. I'm still in the same practice that I started at 20 years ago, dating myself a little bit. So I started getting into real estate investing really heavily in 2018, 2019, after a bit of a realization that, the stock market wasn't treating me as well as I had hoped. So that's what brought me to real estate. But yeah, that's basically, I love my medicine still. I still work full time. I'm here at the clinic right now. I'm going to start my day here pretty soon, but also love real estate.
I love it. So you said you really, studied medicine in Canada, moved down to Southern California because you love the weather. And I mean, we all know that you can't beat Southern California weather, but you were really investing in stocks and other things, started moving to real estate in 2018, as you were a little disappointed with kind of where the stock portfolio was at that time. Talk to us a little about that, right? Because you got a little bit of an interesting background, being that, one, you're still a full-time physician, two, you're Canadian. So as you kind of move to the States, when you think about investing, were there any challenges or any kind of red tape that you had to overcome to get started?
Well, coming from Canada, it's not as easy as you might think. We can't just come down here and start working. We do need a visa. And so for me to receive the visa, it was like an H-1B visa. And that sucker was hard to get. I mean, there's a lot of red tape. And so I was very grateful when I finally got down here and had an employer who was willing to sponsor me and state that there's no Americans that could, do this job. And so they really needed a female doc at the time. And so that worked out really well. Once you live here, you can invest in real estate as long as you've got your social and your US bank account. So that was easy. And I did start to invest in a primary residence initially when I first came down here. And that went not so well in the end, with buying in 2003 and then, having to sell it later on. So because of the crash in 2007. But around that time in 2007, 2008, I had a realtor friend tell me that I should buy a house. And this was as everything had plummeted, including the house I was living in. And I was like, I don't know about this. But he's like, trust me, Inland Empire is going to be hot. So I'm in San Diego and Riverside County is right north of us. And that's the Inland Empire. And so I bought a short sale home for like $225K. And it was a big house, kind of new. It was 2,500 square feet or 3,000, 4 bedrooms. And I was like, oh my God, what am I doing? But it ended up being one of my best investments. I just didn't realize it at the time. I was scared. I didn't do any research. I just listened to this friend of mine and it turned out for the best. But I didn't know that, hey, I should have been buying one every year, not just one, and then kind of sitting back and forgetting. And then, until my, deeper dive into real estate happened 10 years later, really.
Do you still own that property?
I do. Yeah.
What's that valued at now, roughly?
It's about almost 700,000.
Wow. So you bought at 225. It's been a little more than 10 years, 10 to 15 years at this point, but it's now valued close to $700,000. So huge investment, a huge upside for you. And obviously just shows that over time, the power of real estate investing is really, really strong. You mentioned that you weren't as satisfied with the stock portfolio, and that's what really got you to focus more on real estate. What was it about that transition for you back in 2018 that got you to really lock in? Well,
basically, I got married in 2009. And around that time was, this was my second marriage. I really wanted to do life right. I wanted to be like, this is going to be different. It's going to be better. And I talked to my financial advisor when I was about 35, and I said, this was around the time I was getting married, and I was like, I want to retire when I'm 45. And he like kind of smirked a little bit, and he's like, do you know how much money you're going to need? And I was like, well, I don't know. And he said, you're going to need probably $4 to $5 million to assume a safe tax withdrawal rate, or a withdrawal rate of 4%, including inflation, blah, blah, blah. At this time, I wasn't even an accredited investor, so I didn't have much. I had lost quite a bit in the divorce that I went through. So I was kind of crushed. I was like, oh, okay, well, shoot. What am I going to do? Well, I'm going to work hard. I'm going to work really hard at my W-2 job. I'm going to see as many patients as I can. I'm going to save as much money as I can. And so for the next 8 years, I saved over half of my income. And, make a pretty good income as a physician. And any bonuses that came in, I saved them all. I put them into the stock market, because what else do you do, right? And I was kind of meticulously taking, record of my assets and stuff every year. And then I was also doing the delta between the years. And then one day, after about 8 years, I decided to put it on a graph. I'm like, oh, what's the pivot table do? Oh, okay, cool. So I've got this graph, and I realized it was kind of shocking that the delta between the years was kind of what I had saved when I had lined it up with what I had actually saved, and the line was very linear. And I was like, oh, well, this is disappointing. Where's that compounding? Where's this that exponential curve that I was kind of hoping for? And I had to sit down and really kind of do some research and digging. And I realized that, number one, compounding doesn't happen in 8 years. It happens in decades. And I don't have decades when I'm already in my 40s, right? And secondly, even though it was a bull market and the stocks were doing well, returning probably, 8% a year or something like that, there just isn't enough reward in the stock market to really increase your net worth. And that's when I just had a kind of an aha moment, oh my God, this is not working for me. I'm 45 now. I need to do something completely different. What is it going to be? How am I going to increase my returns? And I in the back of my mind, I was like, oh, it's going to be real estate for sure. Because, I've got this house and it's doing really well. And I wrote Rich Dad, Poor Dad when I was right out of, residency, but it was it wasn't right for me at that time because I was so focused on my new career and student loans and stuff like that. So I was like, I got to get back to real estate. And of course, looking at my local area in 2018, I thought I would just repeat what I did in 2008. Well, no, that isn't going to happen. So, the houses were too expensive. Nothing would cash flow. I dug deep into bigger pockets and did a ton of their courses and learning their calculators. And thank God for that rental calculator that they have, because it saved my butt, because I would do some back of the napkin stuff on a condo, here in San Diego. And I'd be like, oh yeah, that could work. And then I would plug in all the other variables. And I was like, oh no, that's not going to work. And, the realtor I was working with, he was like, well, you got to feed it. And, maybe he was right. Maybe if I had invested back then, the course values have appreciated significantly, and that might have worked out. But I didn't want to feed it. I wanted it to have some cash flow. And the idea in my head was, number one, I want to increase my net worth. Number two, I want to increase my passive income. And so I was focused on that. And so anything I did had to have some cash flow. And I kept looking at different ways to invest. What do you do? You're in Southern California. It's expensive. Cap rates are low. The meetups I went to with people were doing investments in duplexes and single family homes in very low cost areas across the country, maybe Kansas or Memphis, Tennessee. And the idea of buying a single family home that was mine, that I was responsible for, I was on the mortgage, and I didn't even know anything about that area. It kind of scared me. And plus the cash flow wasn't enough to really make it worth it. So I kept looking and looking. And that's when I stumbled across multifamily syndications. First, syndications. I'm like, what the heck is that? And then I looked into it and talked to some people, and I was like, oh my gosh, this is perfect. This is really going to be perfect for me because I have capital. I don't have time. I'm in an expensive area, but I can invest in Texas or Florida and receive cash flow and all the benefits of real estate. So I was pretty stoked when I figured that out in about 2018.
I love it. I love it. Great insights right there. And I want to just play back some of this. So one, you took a look at your investments, right? And at this point, it's been 8 to 10 years or so focusing on the stock market, and you were really just slightly above what you were saving. So hadn't really made some big investments, big improvements. And you realize that compounding really takes decades, not years. So that was one of the big insights you realized there, taking a look at your portfolio and your performance. And I thought you had some great things that we should all play back. And some of this people know and do, but just listen to it real quick. You said, you weren't where you wanted to be. You were looking at retirement and needed to save somewhere between $4 and $5 million. So you worked hard, you saved your money, you invested in the stock market, and you reviewed that portfolio annually. And as you did that, you started to realize, you know what, this isn't working as well as I thought it was going to work. What about that real estate? I did the one deal that worked extremely well. Why don't I do more of that? And then you set out to focus more on real estate, ultimately finding multifamily and syndications where, because you didn't have as much free time and you weren't, in the best market for, passive income or cash flow in San Diego, you can invest passively in other markets and get those same benefits. And that's something that I think everyone needs to understand, is that this is just a tool in your tool belt. It's a strategy. You have to figure out your own situation. But for you, you're a high income earner. You were looking to really get some passive income as well as build your nest egg. And this was a great tool to help you do that. Talk to me about the first deal. So you kind of go through all this research, you go to the bigger pockets calculator, all that stuff. You finally realize, hey, syndications, that makes sense. That's where I should go. How do you select your first deal?
Well, I reached out to somebody on Bigger Pockets who had posted and sounded knowledgeable. We got to chatting, and then he let me know about this opportunity in Dallas, Fort Worth. And so I was like, okay, let me look at it. It was my first deck. I'd never seen one before. And the returns, it was 8% pref at that time. And I was like, okay, I think I want to do this. I think this is good for me. So I actually flew out to Dallas. And, I figured 50K is a lot of money to invest, and I should probably make sure that this is a real thing and not a scam. So I flew to Dallas and walked the property, met the operator, met the property manager, and I was convinced. I also did, background checks on everybody just to make sure. I had recently lost a couple $1,000s from someone who was repairing our van. And so I was a little bit skittish at that point. So, but, it worked out, and I invested in, by the end of that year, I was in like 5 or 6 deals.
Wow, it's amazing here. So you did the first one, vetted them out, traveled down to the market, took a look at the property, met the operator, met the property management team, and that gave you the comfort to move forward. And you said you did do a background check. For someone who's maybe in this position that you were in then, new to the space, looking to do that first investment deal, what advice would you give them on selecting the operator or vetting that operator?
Well, there's a lot that goes into vetting an operator, but it all comes down to, can you trust them? And then, trust but verify. So, you need to go in and just do a quick Google search on this person or a couple of people. If you don't want to do the full, criminal background check, that does require a social security number if you want the full one, like a credit check, obviously. But you can find out a lot about people on the internet, and it's interesting to me that some people literally trust and don't even bother with that. So you want to make sure that the operator that you're working with, or the person that you're working with, has a good track record, and so you want to ask for that, and you want to talk to them. You want to get a feel for how they answer your questions, and do they mind sitting with you on the phone for 30 or 40 minutes and kind of going through all your questions, and find out what kind of communications you're going to be getting going forward. You want to really understand, when are my distributions going to start? What can I expect from you, this first year? For example, I'm in a couple of construction projects where the first year is just permitting. Nothing's happening really. It's all paperwork, and investors get a little antsy, but it's because expectations weren't maybe set, like, hey, there's not much happening in the first year, so you're probably not going to hear much, versus a stabilized multifamily property. They jump in, they get going. There's new signs, there's new clubhouse, all these updates to be given monthly. So you want to find out the communication pattern. Make sure you feel comfortable. Do a gut check on yourself. If you don't feel comfortable with a person, or there's something that just doesn't feel right, then don't do it. There's lots of deals out there. You want to go with one that makes you comfortable. And if you can get a reference, that's really good as well. Of course, the operator will provide references, but if you can, I try to work in a network. So I try not to work with people that I just met on LinkedIn. I'd like to have a warm handoff or an introduction from somebody that I know. Those are a couple things.
Yeah, my takeaway there is, take the time to get to know them, ask, good questions, and learn more about their operations, how they operate, get referrals. If you can do a background check, or at least, Google them and try to find whatever information you can on that individual. But ultimately, you want to gather this information and make sure you feel comfortable. If you're not comfortable with that person, then take the time to just get to either know them better or find some other people that you may want to work with. Really good insights there. And you mentioned that you went from that first deal, 50K investment, to you were in 5 syndications by the end of the year. What got you so comfortable to ramp up and do even more of those deals?
Well, first I started digging in deeper into what syndication was and learning the inside of it. So not just as an LP, but as a GP. And so I joined a coaching team and, just sort of jumped in with both feet. I think when I first started looking into real estate, I came home from the library with like a big stack of real estate books, most of which were completely outdated. But anyways, and my husband was like, "Oh, she's got a new hobby, a new fad. It's gonna pass." And then it stuck. And so when I get into things, I go and just kind of jump in. So that's what I did. And therefore, because I was now a small GP, like on some deals, then it just encouraged me to invest in every deal that I offered people. And I was just bringing in just a few people, friends and family and stuff like that. So that really helped spur it along.
A lot of limited partners are interested in moving to the GP side of the table, right? And it sounds like that's exactly what you did in that first year. What tips would you give for someone who wants to follow in your footsteps, maybe invest passively, but ultimately become a general partner?
Well, you need to develop some credibility in the field. So you can't go from just being, doctor, dentist, and then tell your friends at work or your friends, in your social circle, oh, okay, now I'm a general partner of an apartment building, and can you give me $50,000? And they'll be like, what are you talking about? So you want to start maybe posting stuff online, write a few blogs. I wrote a book which helped, provide a lot of like credibility as well, and do interviews like this, explain your point of view, and just educate people. So you want to start with education first, and then you can start doing, and then you should do a couple deals on your own, of course. I try not to bring in, I don't bring in any investors unless I've invested with an operator first. So I can give firsthand knowledge, because the last thing I want is for any of my investors to lose money, or not even lose money, but just have a bad, like not a good experience where they're not pleased with how things are going. So I really want to know the operator well before I would bring anybody in.
All right, Vanessa, you've done a lot of different deals now at this point, some self-storage, some manufactured home parks, multifamily. What goes into your mind when you are thinking about the asset class that you're investing in, the markets that you're investing in? What's your criteria? How do you evaluate these different opportunities?
Well, I like to diversify. So when I first got into this, I didn't know anything except multifamily and a mobile home park. We did a little bit of that, maybe a little bit of self-storage, but it was mostly multifamily. And so I was all in. I was growing my portfolio of real estate, and it was almost all multifamily. And that was great until I joined some masterminds where I learned about other things that should be in a portfolio. And I was like, oh, I didn't know that. Okay. So then I added these other, things into my portfolio. And so right now I look at diversifying as much as possible. I don't want all my eggs in one basket. And so I will calculate the percentages of each thing in my portfolio. Like, how much self-storage do I have? Do I have any industrial? Do I have any hospitality? Of course, that increases your risk a little bit. So diversifying is good, but going outside of your like immediate circle, it increases your risk. And so you have to be very careful about that. So it's a balance of wanting to spread everything around, but also stick with people that you trust and know. And so, because unfortunately, investing is risky, and there's always risk involved whenever you invest. And that includes the stock market, which I think is even more risky than real estate.
So we talked about diversification, which I think is key. And even if you like your stock portfolio, adding real estate to that portfolio is a great way to get that diversification. And as you're looking at that, taking it, a couple steps further, you're in different asset classes, but you're also in different markets. You live in San Diego. I know you mentioned that DFW was the first market for that first multifamily deal. What markets are you in today?
Currently, Georgia, Florida, the Carolinas, and Arizona.
Okay. Now, those are, those Sunbelt states that are seeing population growth and job diversification and a lot of the metrics we like to look for. Has anything changed, as you think about, things you've learned from maybe those first couple of deals to where you're at today? Has anything changed or crystallized to say, you know what, I won't do that again?
Yeah, well, certain markets, if I don't know them well, I need to be very cautious about that. I did a deal in Nashville, which seemed like a great deal. It was a hospitality opportunity. And I was part of a mastermind at the time, and they were, promoting this deal, and I didn't do my due diligence. And I didn't know anything about Nashville. I'm sure Nashville's a good market, but I don't know that for sure. It's not one of my core markets. And so when you go outside of your area of expertise, be extra cautious. That deal ended up going south, and I don't know if I could have prevented that if I had done more due diligence. But we all have to be prepared that at some point we might lose some money.
And on a market like that, when you talk about a deal going south, was that market related or market driven, or is that more operator or something else?
Yeah, that's fraud. It was an operator.
Ah, okay.
Is a bad actor.
Got it.
And the market I think is fine, but I didn't do really enough research on that opportunity, and so
Got
I
it.
definitely learned my lesson there. There was probably some red flags that I could have picked up on.
So to play that back, it was less that it was Nashville and it was a new market. It was more you just didn't do your overall due diligence on that operator, the opportunity holistically, so that, the market itself, maybe the market was good, maybe it wasn't, but overall, the due diligence process broke down there.
Yeah.
You talked about that, and that's a struggle, right? And you kind of, you alluded to it early, and it's a question that investors, I very rarely have heard someone ask me directly, but I know it's always in the back of their mind, right? And it's, how can I lose my money on a deal? Or is this fraud? Is this, a scheme or something, right? And no one ever wants to say it directly, but it's something I do think you should get off your chest because, if that's the thing that's going to hold you back, we want to make sure we can address that. For someone who has been, invested in deals where it's gone great and you got, a great experience that you were looking for, to the point where you felt comfortable bringing other people in your circle into these deals, to doing a deal where there was some fraud and you did have a bad actor that, played out and lost some money. How do you manage kind of that approach, right? And how do you make sure that there's nothing fraudulent taking place when you are investing in the deal?
Well, yeah, I mean, I definitely got burned. And so I've been more cautious recently, whereby I'm sticking with sort of the circle of people that I know and not really taking on new operators unless I have a reference, unless they have a good thought leadership platform and, thereby probably have a lot to lose. You're not going to see big operators, doing fraudulent stuff. It's usually these smaller companies. And so, yeah, I'm just really cautious, and I prefer to work with people that I know well, and I do want to get to know them, and I don't jump in on a deal like, hey, I just met you, let's do a deal, or they need funds. Like I've had, after conferences, I get approached by a lot of people with current deals, and they're absolutely not. No, I need to get to know you first, and we need to have some conversations before we can do a deal together.
There's great insights. First of all, get to know these people, get to know them well. If they're in your circle, great. If they're not, take your time. There's no reason to rush if you don't know someone. It goes back to being comfortable, right? Everyone is excited. I know we're all excited to get deals and build a portfolio and get it going, but take your time, do that due diligence, get to know people and build from there. You said something I thought was great, and it's something that we've really emphasized as well. And you said, if they don't have kind of a thought leadership platform, you're hesitant to work with them. And said differently, there's reputational risk on the line. If someone is out there and they've built their brand and their business based on, the podcasts or blogs or books or whatever it is, they're going to be more hesitant to do anything that will disrupt years of effort to build up. So we know that reputations can be destroyed in minutes, and they take years to build up. And that's really important. And, when you're working with someone, I do want to understand, what kind of risk you have. Money is one thing. And I always hear people say, do they have skin in the game? Do they have equity in the game? While that's important, I think reputational risk is more, because that's more difficult to get back. It takes years to build up a reputation. So, those individuals who have that on the line are typically going to go a little further and beyond to protect that reputation to the fullest extent of their possibilities. So I really like that you shared that point as well. Vanessa, let's talk a little bit more about where things are headed, right? You mentioned that you got some information on your website, the book you wrote. Anybody can go to vmdinvesting.com to check that out. But as you look to go forward with your investing and your portfolio, what are you looking at right now?
Well, yeah, I mean, I love land entitlement. And so I am a general partner on a land entitlement fund, which is a really great place to be with a major shortage of houses nationwide and helping provide entitled land to the national home builders. And so it's a cash flowing fund. And so that's one of the things that I learned recently through mastermind groups is that, my portfolio doesn't need to be all equity. Debt is a really, really good way to help people get out of their jobs if they want to, because it's cash flowing. Yes, it's going to be taxable income, but it's good to have a balance. And if you've got some taxable income and then you've got losses from multifamily syndications, and they can offset each other. So you've got passive income, passive losses. That's a really good combination. And I have been able to triple my passive income this past year just by meeting a couple of key operators that help me with that, including this land entitlement fund, which provides great cash flow. I love multifamily still, and I'm still doing a fair amount of that. And so I like to have an operator or two in multifamily. I have an operator in self-storage, and no mobile home parks right now, but I do love that asset class as well.
When you say land entitlement, for someone hearing that for the first time, it can be a little confusing. Can you break that down a little bit more?
Sure. Yeah. Land entitlement is basically taking the process of raw land through shovel ready. So there's a lot of steps involved that go through, permits, zoning, an environmental assessment, an engineering survey. Basically, it's a lot of paperwork. There's no digging except for soil samples. There's no putting in any kind of infrastructure. It's just raw land. And so we say it for the fund, we're in and out at raw land. So we take raw land, we get it permitted and ready to go, and then it's sold off to a national home builder. And they don't want to buy land that's raw. And the reason that they don't is because in 2007, 2008, 2009, they really got burned because they used to do the entire process. They had a whole part of their company that was just focused on land entitlement. And so they had various stages of that on their books. And of course, when the crash occurred, nobody wanted anything to do with new homes. There was a glut of houses on the market. And so they had to take a bath on that. And so going forward, all of the big guys like D.R. Horton and Leonard, Anatomy, et cetera, they all like to buy it when it's ready to go. It shortens up their time and reduces their risk. And so it's a profitable niche to be in right now.
There you go. Thank you for breaking that down, because we hear land entitlements from time to time, and I don't think we've ever really had anyone break that down. So I appreciate you sharing that a little bit more. And then for that investment, you mentioned it's raw land when you get it. You all go through essentially the paperwork process, getting all the permits and everything ready for it to be shovel ready. But at that point, you're going to sell it to a developer. What's the time frame typically on that? And what kind of profits are you seeing? Just general ballpark, but like what kind of profits are you looking at for that?
So it's a 9 to 18 month process for the land entitlement. And we're not doing small pieces of land. There's usually a minimum of 500 homes that would fit on a piece of land. And so basically the process depends on the city and depends where you're at. And so we're only working in South Carolina and Florida, and we're opening up in Phoenix shortly. But it's hyper local, meaning that the guys who are doing the actual work need to be boots on the ground. They need to know the people of the city. They need to know who to call to push through this checkbox that didn't get done. You really have to know the local people. And so the profits it's an 8% preferred return plus profit sharing. And the profit sharing is anticipated to hit 8%. So 16%, it's cash flow. This is a lending fund. So we lend to this operator. So we're like bridge debt for the lender. We're lending to the operator who's doing the actual work. So us on the fund side, we're not doing the actual entitling. It's definitely for specialists to do. It's not a weekend course to find out how to do that.
No, exactly. Right. But to your point, you're on the lending arm of that. So it's not like you're the one who's buying the land and then going through this process and selling it. You're actually lending to the person buying the land, letting them go through that process. And then once they're sold, you kind of get the payout there. So really great insights right there on that fund. For people who want to learn more about that, I'm assuming they can just come to your website. Is that right?
Correct. Yep. Yeah, awesome. Absolutely. And there's a link to check if you'd like to book a call with me. There's a calendar link there. So I'd be happy to chat with anybody who's interested.
There you go. And Vanessa also has a roadmap. If you're interested in figuring out your road to retirement, you can check that out at vmdinvesting.com/roadmap. But check out our website. There's plenty of information there. Vanessa, I want to move to our round of insights. Are you ready?
Mm-hmm.
All right, give me a failure or an apparent failure that sets you up for later success.
Well, yeah, I would say that I feel like the loss of money from the fraudulent investment has really sort of helped me hone my skills and make sure that I'm more cautious in terms of doing my own investments personally, and learning that I'm a sort of a trusting person and naturally, and just being a little bit more cautious in terms of who I invest with. So I feel like that going forward is going to serve me extremely well, and also make sure that I am thoughtful about the places where I put my money. And I think I was early on, it was kind of like, woohoo, this is great. I'm just going to invest all this money and, it's all going to be good. And it has turned out extremely good. I mean, fortunately, that loss is actually 4 years ago, I would have been more devastated, but now it's like, oh, okay, well, it's only a small portion of my total net worth at this point, but it would have been a lot more painful before. So a painful lesson learned.
Give me a digital or mobile resource you recommend for your business.
Digital or mobile resource? Well, I do love Bigger Pockets, and I think if anybody's interested in investing in real estate, they should definitely hop on there and learn as much as you can from there. Mobile, don't really have any mobile resources though.
All right. Give me the book you've recommended or gifted the most in the last year.
Well, my own. I've given my book to, I give it to anybody who I talk to on the phone. I offer them a free copy of my book. And what other books? I do like Joe Fairless's Apartment Syndication book, a big red book, which really dives in, and that was what helped me get started.
What's a daily habit that helps you stay focused on your goals?
Meditating. Yeah, every morning, 10 minutes of meditation. I have a Spotify playlist that's the same, and I just play that, and that tells me when I'm done, and that really helps center me before I get my day started.
What's your number one insight for investing?
Work with people that you trust and trust your gut, and make sure to not balance of action and inaction. So a lot of folks get hung up on that perfect investment, like the first investment has got to be the perfect one. I'll have people ask me, well, what should I do? Because maybe I have 2 or 3 opportunities, and they're like, this is their first one. They want to know which one is the best one. And I tell people, you're going to do lots of investments. So at some point, do your due diligence and then make a friggin' decision. You just got to do it at some point. Because if you sit on the sidelines, life's going to pass you by, and you're going to end up working longer than you thought, less money than you thought, all of it in the stock market. And it goes up and down. Who knows what's going to happen? The quarterly earnings report are coming out this week, and everybody's on pins and needles about what's going to happen to the stocks. It's like, I don't care about that. I hardly have any money in the stock market.
Yeah, I mean, always be investing and figure out, how to navigate the current environment. But, sitting on the sidelines has, I don't think that works for very many people. So good to hear. Let's lighten it up, right? So you're in San Diego. I'm curious to hear what's your favorite place to grab a bite to eat?
Oh, that's a tough question here in San Diego because there are lots of good places to eat. Right now, I would say my favorite is it's Miko Sushi right down the street from where I work. Yeah.
Awesome. Miko Sushi. All right. Excellent. Well, listen, Vanessa, you gave us a lot of great information today talking about, your transition from, really focusing on just stocks to realizing that real estate was an area you wanted to get into, why you wanted to get into real estate more passively first, and then kind of being active. And then also how you're able to do this, while working a full-time job, and really just inviting other people to join you on some of the deals. But you're doing that by building your own thought leadership platform, building your own credibility, writing blogs, doing interviews, and making sure that you're building up your reputation as well. And thanks for sharing some of the hardships you face investing and the process you've taken to do due diligence on different operators. And I think it's very helpful and informative for anyone who's looking to grow their own portfolio. Again, if you want to connect with Vanessa, you can check out her website, vmdinvesting.com. We'll make sure we put a link to that in our show notes. I want to thank you again and hope you have a great day.
Thank you.